Taking a little bit of time to get things going today in the market because wasn't really sure what it wanted to do after the CPI, but we're trying to get something going here. 174 on the Dow, that's 0.5%. NASDAQ, S&P positive as well. There's the yield on the 10-year note as well, right? Yields went up initially, then they fell. 349 is where we're at on the 10-year. So, Carrie, where does all of this leave us now?
Well, the market is pleased, I would say, of course, that inflation is still coming down. A little bit of what have you done for us lately? Because we know we have earnings to talk about over the next few weeks, and we're going to hear a lot of information about guidance and what 2023 looks like. But the truth is, there have been buyers over the last few weeks. We've seen it. The market is showing a little bit of interest in stocks. The most positive thing about the market is that people have been so negative. The bears are overwhelming. It's really hard to find anyone to say something positive about stocks. And if you look at just growth versus value, you look at a little table we did, you can see that value outperformed by 20% last year. An amazing year for energy stocks and consumer staples. So it's not unreasonable that when stocks are down 50 to 70%, they start to get a look by people who say, you know, if we can buy Meta or Google, less than the market multiple, 14 times earnings, 15 times earnings, there is some attractive buys. And so I think the market is showing a little bit of strength in that regard.
Maybe, Jason, we're going to have a scenario as earnings kick off tomorrow, right, in a big way with the banks, and then all the parade starts after that. Maybe we're going to find ourselves in that scenario again where earnings aren't as bad as we think, right? This runway to disaster is maybe pushed off, and maybe the disaster never happened. Some are talking about Goldilocks today, that this number was in line with that, right? Fed's hiking, CPI's cooling, jobless claims aren't exploding. You agree with that?
So I wouldn't go that far. I think, from an earnings perspective, obviously the bar has been lowered, and I think that's obviously a positive. I mean, we have a 6 handle on CPI this morning, which is also positive. And let the trend be your friend. 4 months ago, we were above 8%, 7.7, 7.1, today 6.5. And then we look to last week where we saw ISM numbers, wage inflation is decelerating. All these are positives for the market. And again, the earnings story has been, the bar has been reset down about 4% has been consensus. Q3 of 2020 was the last time analysts pulled the earnings growth down this much. So I think we can see some solid earnings this quarter, but I'm still relatively defensive, but starting to get more optimistic about the future ahead.
Sarat, I wonder if it's getting dangerous to be too negative in the market.
I think you're right there.
How do you address that?
If you get too negative, then you're never going to get back in, and especially if things kind of we're doing a balancing act right now where CPI number was good. So that meant the economy isn't slowing down as much as people think it is. And maybe it'll keep on slowing down, but it gives the Fed some leeway and it allows the Fed to do what they're doing. But it also takes the Fed a little bit out of the picture. So let's focus on this next quarter. Let's see what companies are saying. Let's see what demand is. I think that's going to be really important. And can they keep up their margins? And if they're seeing pricing come down, whether it's supply chain, whether it's coming inventories, chips, I think that's going to be better for the market. So to be diversified and balanced in this market, I think is the right thing to do.
Farmer Jim over here has been trying to tell people that you're too negative, that the economy's stronger than people want to give it credit for, that earnings aren't falling off a cliff that everyone keeps predicting. The Fed's not going to go nearly as high as people think because they're not going to have to because inflation continues to cool, evidenced yet again by today. Maybe you had a little bit of a sell the news event at the beginning today because it was in line. It wasn't blow you away, CPI. But how about that? Right? That's the story you've been telling.
Yeah, I think I'm going to go have lunch, Scott.
Summed it up pretty well, didn't I?
Pretty darn well. I'll add a little bit to it, though. It was very good. Very good. Thank you. Take the last 6 months of the CPI reports, take those month-over-month increases, chain link them to the product. The number is 0.9%. The last 6 months, headline inflation, as measured by the CPI, up 0.9%. I'll do a little higher math here. If you annualize that, what number does that come to? Don't. It's 1.8%. What's the point here? Now, listen, I know I'm being cute, but those are facts I just gave you. The last 6 months, headline CPI has increased 1.8%. That doesn't necessarily mean that's what the next 6 months is going to bring, so I don't think that the Fed is going to stop raising rates. But what the Fed would be wise to do is raise 25 basis points in February, stop the jawboning, which is more politely put as forward guidance, just back off a little bit and say we're going to be data dependent. That would be the wise thing to do because the Fed has another mandate, which is maximum employment, and the initial jobless claims on top of last week's labor report tells you they're getting the soft landing. Now, there's one question, Judge, still to be resolved, which is how much damage has been done. And certainly there will have been some damage done to earnings. Let's start looking tomorrow. You are correct, though. I don't think it is as bad as everybody fears. We're looking, the estimates are down 2% year over year for the fourth quarter. I think if you come in flat, which is not, take a look at American Airlines pre-announcement today, just as an example. I know it's only one company, but it may not be as bad as feared. Just that simple.
That's right.